A very good evening to all. How are you all? Doing good? Getting ready for your exams? Just few months, I can say, left for your second most important exam of your life. So I can see many guys are online. Sapna is there, Jnanish is there, Priyanka is there. Okay. So Vinay is also joining. Great. Well, today's class is something which we want to dedicate towards the finishing touch for the chapter of capital structure. We're going to provide some finishing touch or completing the chapter of capital structure, but from a theoretical point of view, or we are going to enjoy the debate that's going on between two set of economists. Okay, so let's get started. But before that, just to quickly recap, in the previous class of capital structure, what we have done is we have identified the technique, a very simple way of identifying how to select which plan to be chosen for application of for raising the funds. So we had multiple plans in front of us, and the criteria on the basis of which we were choosing the plan was primarily EPS. But along with EPS, if the question also gives you information about the P ratio, then we choose the plan which was having the highest market price per share. After that, we also learned the concept of financial break-even point, at which we stated this is the sales value at which your it's the EBIT value at which your net profit for equity shareholder was 0. So we said that if your anticipated earnings before interest and tax, if it's more than your financial break-even point, then you should then that's going to be a positive net profit for your earnings per share. Similarly, if it was below financial break-even point, then your equity shareholders are actually making losses. And if it's equal, then we said that the net profit for equity shareholder is 0. Then we also derived the formula for financial break-even point, which was preference dividend upon 1 minus T plus interest. We also learned another thing in the chapter, that's about the indifference point. That's the level of EBIT at which both plans are indifferent, or I can say EPS of both plans are equal, right? And the simple way to calculate this financial indifference point was to equate EPS of both the plans. By simple arithmetic calculation, we have obtained this indifference point. And the importance of this indifference point was, this was a reference point which was telling us that if your anticipated EBIT is above the indifference point, then you should go for the risky plan, because capital gearing is beneficial only if you are having a greater degree of sales or a greater degree of your return on capital employed. So for higher EBITs, that is EBIT above the indifference point, plan 1 was dominating, and the EBIT is below the indifference point, plan 2 was dominating. Okay. So that was like plan 1 was dominating, which is in the sense that plan 1 was more risky. So if plan is less risky, EBIT less than indifference point is suitable. And if plan is more risky, then EBIT greater than indifference point is suitable. Right. So this is what we have discussed so far in the previous class. Right now, let's get started with the next concept, next set of concepts that we have in capital structure. I don't say these things to be concepts per se, but then these are a part of, these are not the concepts, but some theories, some, statements which have been made by notable economists, and for which many of them have won even the Nobel Prize. So there's a debate which is running, which is ongoing even today, which talks about the capital structure theories. Now, what are those? What is this debate? So let's say there are two companies, X and Y, who have the same business model. When I say same business model, it means the same product they are providing, they are dealing with the same services, and because of the same business or same services, the EBIT remains same. EBIT is same for both the entities, and let's say the total capital employed is also same for both the entities. Okay, so in both the cases, for both companies X and Y, business is same, EBIT is same, total capital employed is same. So what's something that distinguishing, or what is something that's different for X and Y? In case of capital structure, we say company X has got, let's say, 100% equity, and company Y has got partly equity and it has got partly debt. Now, it will be dumb to say that, company Y is having 100% debt, because you cannot incorporate a company with 100% debt. So everything is same for both the companies except the capital structure. Except the capital structure. So company X is a fully equity company, whereas company Y is partly equity and partly debt. So under such scenario, we would like to know a very interesting hypothesis or a very interesting question. That's the point of debate altogether. What about the market value of both the companies? What about the market value of both the companies? Is the market value of both X and Y going to be same? Is it going to be same, or is it going to be different? Right? So that is what we mean by the discussion of this debate. So the discussion of this debate is all about whether market value of these two companies is going to be same, or is it going to be different. Just because capital structure is different, will both the companies be valued differently in the market, or are they going to be valued on the similar lines in the market? Right? So that's what this whole debate is all about. So I can see answers coming in from Alok, Petledwala, Khujema, Jnanish, Igne, then Shankaran, that, sir, both the companies should be having different values. Now, that's the beauty of this typical concept, which talks about, whether they should be valued differently or whether they should be valued on a similar lines. So we'll discuss them. So what is that? Let's understand it in a later stage. But right now, let's first talk of how do we obtain the value of an asset? How do we obtain the value of an asset? Or value of any liability, or for that case, value of anything. If I ask you, give me the value of this pen, or if I ask you, give me the value of this mouse, if I ask you, give me the value of this laptop, if I ask you, give me the value of the cell phone. Whenever we talk of value of an asset, how do we calculate the value of that typical asset? What is the method, or what's the way to calculate value of an asset? Yeah, guys, what can you say about it? How are you going to calculate the value of any asset? How are you going to calculate the value of any asset? Well, it's pretty simple. Value of any asset, guys. Value of any asset for that matter. It is simply what we can say is it is the present value. Value of any asset is simply present value of future cash flow. It is the present value of future cash flows. The value of any asset is simply the present value of future cash flows. So whenever we talk of value of asset, that's called to be the present value of future cash flow. Now, how do we go about thinking? How do we calculate this present value of future cash flow? Or give me some justification, sir. How are you going to say that value of the asset is present value of future cash flow? Let us say one debenture, or not one debenture. Let us say you are opening a bank FD. Okay, bank FD. In day zero, you deposit in day zero, you deposit, let's say, 1 lakh. Okay. In day zero, you deposit 1 lakh. Some network issue, guys. Yeah, some network issue. Okay. So let's come back. Let's get back. So let's say we are looking for a bank FD. On day zero, you're going to make a deposit of 1 lakh, and on day 365, you're going to realize 1 lakh 10,000. Now, to get 1 lakh 10,000 on a future date, can I say this 1 lakh 10,000? Like this 1 lakh 10,000. Can I say this is your future value of 1 lakh 10,000 is future value of the FD, and this 1 lakh is the present value of FD. Now, to get this fixed deposit, today, which will give you 1 lakh 10,000 on a future date, you're ready to pay 1 lakh. And can I say that this 1 lakh in year zero is actually present value of 1 lakh 10,000 in year one? Right? So that's where we say that whenever we say present value of any asset, the current value of any asset, it is going to be present value of all the future cash flows. All the future cash flows that you're going to get, we need to bring it to present value level to arrive at a value which will be the fair value as of today. Okay. So this FD was worth 1 lakh because it was going to give you 1 lakh 10,000. You were ready to pay 1 lakh for this FD because it promised you 1 lakh 10,000 after 1 year, and the rate of return which you required, it was 10%. Okay. So when we talk of the value of an asset, that's going to be present value of future cash flow, right? Present value of future cash flow. Now, what is the cash flow that an equity shareholder gets? What is the cash flow for equity shareholder? What is the cash flow for equity shareholder? Tell me. Cash flow for equity shareholder. What will be the cash flow for equity shareholder? So for cash flow for equity shareholder will be dividend per share, right? And if I assume that there is 100% dividend payout, if I assume that there is a 100% dividend payout, can I say dividend per share will be same as what the company is earning, which is earnings per share? So cash flow for equity shareholder will be dividend per share, right? Dividend per share that the shareholder is going to get. And if I say that company is paying out 100% of whatever it is earning, that will become earnings per share, right? Now, of course, if I say earnings per share, that is on a per share basis. So if I ask you for all equity shareholders combined, what is the cash flow for all our equity shareholders combined? Can I say that's going to be your profit after tax? Or and I say if I say for all equity shareholders combined and assuming no preference share capital. So can I say whatever is your profit after tax, that itself, whatever is your profit after tax, that itself is the cash flow for equity shareholder. Now, of course, we are subjecting ourselves to certain assumption. Assumption number one is there is 100% dividend payout, right? Assumption number two is there is no preference share capital. So under these two assumptions, cash flow for equity shareholders is profit after tax. For all the equity shareholders combined, it is profit after tax. Okay. So, sir, if I ask you what should be the value, what should be the value of all equity shares? So we're talking of value of all equity shares. Right? So value of equity, when I talk of it as a value of all equity share, that should be ideally present value of all future profit after tax. So it's going to be present value of all future future profit after tax. Now, of course, we should discounted at present value of all future profit after tax, and this is going to be discounted at cost of equity because that is what is the required return of our equity shareholders. So to simply speak of this, the value of equity should be profit after tax for first year upon 1 plus K plus profit after tax for second year upon 1 plus K square plus profit after tax for third year upon 1 plus K cube. And then it just goes on till infinity, right? And this goes on to infinity. Now, since we have assumed that it is 100% dividend payout, since we have assumed it to be 100% dividend payout, what can you say about the growth rate? I hope you are aware of this formula, guys. Growth rate is equal to B into R, right? Where this B was retention ratio, B was retention ratio multiplied by return on investment. R was return on investment, right? So since we are saying 100% dividend payout, what can you say about the retention ratio? What can you say about retention ratio? Retention ratio is 0. 0 multiplied by return on investment is R. So that's basically growth is 0, sir. And since there is no growth, right? Since there is no growth, can I say, therefore, profit after tax for first year will be same as profit after tax for second year. That will be same as profit after tax for third year. That will be same as profit after tax for fourth year. Can I say, let me just name it as a single profit after tax figure because it's just going to be the same term throughout. Correct? So we can say value of equity, shares. So it is going to be PAT upon 1 plus K plus for the second year. That's going to be again on the similar lines. PAT upon 1 plus K square plus PAT upon 1 plus K cube, and it just goes on till infinity. So if we just take PAT common, inside it, what we see is it is 1 upon 1 plus K plus 1 upon 1 plus K square plus 1 upon 1 plus K cube till infinity. Now, this is the simple case of geometric progression, right? Geometric progression. I hope you guys are aware of geometric progression. Now, the geometric progression, where this is geometric progression where A is 1 upon 1 plus K, and the common multiple is also 1 upon 1 plus K. And what was the formula for summation till infinity? Formula for summation till infinity, it is A upon 1 minus R. Correct? So this entire thing, we can write it as yeah. So we can write this value of equity as equal to PAT into A is 1 upon 1 plus K, 1 minus 1 upon 1 plus K, that's equal to PAT multiplied by 1 by 1 plus K upon 1 plus K minus 1 upon 1 plus K. And that will actually make it as 1 plus K getting cancelled. And we have profit after tax upon. We see that the PAT thing further gets cancelled, or I can say 1 and minus 1 gets cancelled. And what we essentially get is PAT upon KE. So we can say the value of equity is PAT upon K, or this is what we say, the present value of all the future profit after tax discounted at cost of equity. Now, on the similar lines, can you tell me what should be the value of debt? What should be the value of debt? The value of debt should be interest upon cost of debt. Interest upon cost of debt. Then, value of the firm will be, can I say value of equity plus value of debt? Because the overall company will be like a total of equity value plus debt value. Similarly, even the value of firm is stated to be EBIT, that's earnings before interest and tax, upon KO. Okay, earnings before interest and tax upon KO. That's our value of firm. Or I can say the value of equity is PAT upon KE, value of debt is interest upon KD, value of firm will be value of equity plus value of debt. Value of firm will be EBIT upon KO. Okay. Okay. Let me see. I hope this four formula are clear, because these are the basic formula which we'll be using in our calculations and all our theories. Okay, let me see if there are any queries. Sir, Prachi is asking how retention ratio is 0. Actually, we assume that 100% dividend payout, right? So we are assuming this to be 100% dividend. Whatever you're earning, you're just paying it out, and no preference share capital. And under those assumptions, this formula hold true. Okay. What is KO? KO is the overall cost of capital, or weighted average cost of capital. Cost of capital for the entire business as a whole. Just like for equity shareholder, it was KE. Just like for debt, it was cost of debt. And on the similar lines, for the entire firm, overall cost of capital or weighted average cost of capital is KO. Okay, guys? Fine. Great. Now, these are the four basic formulae. Now, as I have said, there is certain discussion that is going to happen about this capital structure. So the discussion that we have right now is going to be about whether capital structure, as we have started, as we have initially begun with it, whether capital structure, considering the debt equity mix, is it going to affect the value of the business? Right? Is it going to be affecting the value of the business? Or we can simply say, is taking debt going to affect the business? Will taking debt for investment in business affect its value? Or you can say, if there are two identical companies, out of which one is geared and other is non-geared, will their values be different? That's the point of debate. Now, there are certain set of economists which say, yes, it is going to get affected. It is going to be getting affected. Or it says that value of the company or the business will be affected by capital structure. And there is another set of theories which say, no, the value of company or business will not be affected by capital structure. Now, if we have such a scenario where the value of the company or business is affected by capital structure, then that theory is going to be said as a relevant theory, or theories of relevance. Theories of relevance means your capital structure is going to change the value of the company. On the other hand, if your value is not affected by the capital structure, then it is said to be a theory of irrelevance. Then it is said to be theory of irrelevance. Now, for theory of relevance, we have got three theories which we have to learn. One is the net income approach, traditional approach, and Modigliani-Miller. stands for Modigliani-Miller. The same Modigliani-Miller is also a irrelevant theory, but when we bring in taxation into it, that becomes a relevant theory. And also we have net operating income approach. Okay. Now, these theory are subject to certain assumptions. They are subject to certain assumptions. Now, what are those assumptions? Look at it. We say that there are only two kinds of funds used by the firm. One is the debt and other is the equity. As I have assumed, there is no preference share capital. Secondly, total assets of the firm are given, and the degree of leverage can be changed by selling debt to purchase shares or selling shares to retire debt. It means we can change our capital structure. I can buy back the equity shares and issue debt in the market, or I can redeem the debentures and issue equity shares in the market. So equity and debt both are interchangeable with each other. That's the second assumption that we look into. Third is no taxes. Of course, when we come to model, we bring in the tax treatment into it. The dividend payout ratio is assumed to be 100%. The dividend payout ratio, whatever is the dividend, whatever you're earning, that's actually being fully paid out. So there is no increase in the earnings. There is no growth that's happening in the earnings. The firm's total financing remains constant. So whatever is the financing, that remains constant. Business risk is constant over time. So whatever is the business risk that we have, that's remaining constant. So when we say firm total financing remains constant, it means the firm is not bringing in any additional capital. It is just going to change the capital structure. Business risk is remaining constant, because if we don't assume this constant, then our theories will not be in a position to be hypotheses and they cannot be tested. And we also say that firm as a perpetual. So these are the assumptions that we need to make to understand the relationship between all these theories, right? I'll just give you a minute to go through this assumptions before we proceed with the next part of our discussion. Yep. I hope it makes sense. Now we can go for the discussion about the theories one by one. First, we will discuss the net income approach, then the net operating income approach, then the traditional approach, then the MM approach without taxes, then we'll also talk about MM with taxes. Right? Nyanesh is asking, it means these theories are not practical. Nyanesh, it's not that theories are not practical. They are the foundation for any practical observation. Like in economics also, you might have learned something called a theory of demand. It was also subject to certain assumptions, right? Theory of supply, theory of diminishing marginal utility. Those are also subject to certain assumptions. So any theory has to be made with certain assumptions, and you have to be, moving around those walls of the assumption set. Then only the theories can be tested and they can be evaluated. Otherwise, they cannot be done, right? Now, of course, in practicality, we may see that some of the things may not be true, like the dividend payout ratio may not be 100% certain. There may be some retention ratio, there may be some growth. That's obviously there. Now, I invite you in such scenario to come up with your theories that if some of these assumptions are violated, what will be the impact on these theories? Like MM was the person who actually removed the assumption of no taxes, right? And he came up with his own model. So I invite you all, great scholars, that you after reaching a certain level of maturity, after reaching certain level of academics, you also try to, come up with some ways by which any of these assumptions can be removed, and then what will be the impact on our theory. Okay. Hani Agarwal is asking, what's the second assumption? Please repeat. Okay. Second assumption is that total assets of the firm are given. That is, if you look at the balance sheet of a company, it will have some assets, it will have some equity, and it will have some debt. Now, the total of debt and equity will be same as the total of assets. Right? Total of debt and equity will be same as total of assets. So whatever is the amount of equity and debt, you can just interchange it. Like initially, you may have 100 equity and 0 debt. You can make it as 50 equity, 50 debt. You can also make it as 10 equity and 90 debt by redeeming the debentures or issuing new debentures by going for buyback of equity shares. So that's the flexibility which is available. You're not bringing in the legal angle over here that you cannot buy back your shares by taking loan. There are other laws which are prohibiting such things. So I'm not bringing those areas, and that's what the assumption is being stated over here also. Okay. Manoj Kumar Thakur is asking, even in exam, we make some assumption to write an answer. Of course, our answers also based on similar assumption. Okay, fine. So let's go for the first theory, which is the net income approach. The net income approach. Okay, let's have a look at it. The net income approach. Now, under the net income approach, the first thing which we say Yeah, net income approach. Let's look at the points one by one. The first thing that we say about the net income approach is, uh, you know, cost of debt is less than cost of equity. Do you all agree with this? Cost of debt is less than cost of equity. You guys agree with this? Yes or no? You guys agree with this? Cost of debt is less than cost of equity. True or false? Tell me. Tell me quick. Cost of debt is less than cost of equity. Is it correct or not? Yeah? Do you agree with it? Okay. What's the answer for which you are saying? What are the answers? Yeah. Do you agree with it? Yes. Cost of debt is definitely, sir, less than cost of equity, guys. Cost of debt is anyways less than the cost of equity at any point of time. This is a very valid thing that we say, because see, who is bearing the the risk of the business? It is the equity shareholders. So definitely equity shareholders are going to be expecting, or they would be requiring, a higher rate of return. And for that reason, we say cost of debt is less than cost of equity always, right? The second point which this theory states is that uh, increase in weightage of debt will lead to decrease in overall cost of capital, or weighted average cost of capital is going to get reduced due to increase in weightage of debt. Now, how do we get the overall cost of capital? KO will be, KO is rather computed as what? Weightage of debt into cost of debt plus weightage of equity into cost of equity. So increase in weighted average, increase in the weightage of debt will lead to decrease in overall cost of capital. Now let's understand how does that happen. See over here, look into this part. In the first scenario, 10,000 equity was there. The amount of equity share capital or amount of equity funds was 10,000. Then, and obviously the debt amount was 0. Weightage of debt was 0. And of course, weightage of equity becomes 1. If I just bring those same numbers over here. Now, of course, these things, I'll just take this over here. Okay. Let me just prove it for you. Okay. So this is what the typical scenario is. So debt is 0, equity is 10,000. So weightage of debt is 0 and weightage of equity is 1. Cost of debt is 10%. Cost of equity is 15%. Cost of debt is 10% and cost of equity is 15%. Now, if I tell you, give me the KO number or overall cost of capital number. So KO will be weightage of debt into cost of debt plus weightage of equity into cost of equity, right? So if you just go ahead with this calculation, overall cost of capital, 0 into 10% plus 1 into 15%. So that's basically 15%. Now, if you do similar calculations over here, 0.1 into 10% plus 0.1 into 10% plus 0.9 into 15%. How much is that? So that's like 15 into 0.9 plus 10% into 1. So that's basically 14.5, right? 14.5%. Then in the second case, the third case, you may get it as 12.5%. And in the last case, you may have it as 9 plus 1.5, which is 10.5%. So what are we observing? What is our observation? As the weightage of debt increases, what is happening to the overall cost of capital? What is happening to the overall cost of capital? Sir, overall cost of capital is actually getting reduced, right? So overall cost of capital is actually getting reduced. So as you increase the weightage of debt, as you take more and more debt in place of equity, the overall cost of capital takes a downturn. Now, the third step, which this net income approach states, is that decrease in KO, that is, when the overall cost of capital reduces, that will cause increase in company value. Decrease in overall cost of capital KO will lead to increase in the company value. Decrease in the overall cost of capital KO will cause the increase in the company value. Now, how is that going to be a scenario? See, as we have stated, there are three scenarios that we are talking of, in which our KO was this figure. Now, for this KO, let us say we want to get the value of the firm, value of the entire business, right? Value of the entire business. So value of the firm, we know as per the formula, it is EBIT upon KO, correct? So if I take the EBIT to be, let's say, some random figure, let us begin with maybe EBIT is 10,000, or maybe let's say EBIT is 15,000 for that case. So EBIT 15,000 divided by 15%. So this makes our company value as 1 lakh, right? Or maybe I'll just take it as 1500. So the company value will be 10,000. Now, same EBIT, when you're going to consider 14.5% as the overall cost of capital, then that's going to be 1500 divided by 0.145, which is 10,344.83. For the third case, that's going to be 1500 divided by 12.5%. 1500 divided by 12.5%, that makes it as 12,000. Then fourth case is 1500 divided by 10.5%. 1500 divided by 10.5%, that makes it as 14,286 or 14,285. 14,285.71. That's the value of the firm. So what are we observing? As the KO is going down, what is happening to the value of the firm? Sir, value of the firm is increasing, right? Value of the firm is moving in the upward direction. So ultimately, if I just connect with the very first principle, that taking more of debt is going to cause increase in the value of the company. If you take a greater degree of debt, if you're going to take a greater degree of debt, what happens is the overall cost of capital reduces. The overall cost of capital reduces, and as KO reduces, value of the firm is going to increase. Okay. So what can you say about the final outcome? Sir, change in capital structure. Change in the capital structure. What impact is it going to have on the value of the company? Is it affecting the value? Of course, yes. There is a change in value of firm, right? So change in the capital structure is actually causing a change in the value of the firm. So that's what we meant by this net income approach. And this net income approach is, it is proved under these three steps: cost of debt less than cost of equity. The increase in weightage of debt will lead to decrease in overall cost of capital. Decrease in KO will lead to increase in the company value, right? And of course, that means change in the capital structure will cause change in the value of the firm. Okay, so is capital structure affecting the value of the firm? Yes, it is affecting as per this net income approach, right? So what's the meaning of leverage over here? Leverage is taking more of a debt into your capital structure, right? So if you are increasing the leverage over here or taking more debt, increasing the weightage of debt, that will cause the increase, that will cause an increase in the value of the firm. Okay. I hope it makes sense for you now. Yeah. So that was our net income approach. Now, if you just try to look at the diagram that we have, well, this diagram, just copy it over here for your reference, because I'm placing all the documents, all the items in one page so that I can upload it for you. Now, that's what this net income approach is. See, as you increase the weightage of debt, this leverage means you can understand weightage of debt. As the weightage of debt increases, what is happening is cost of equity is remaining same as we have seen over here. Cost of debt remains the same as I've seen over here. But what we're changing is the weightage of debt. So overall cost of capital, right? Overall weighted average cost of capital, that is reducing. Okay. So this delta, I have just used it for notation purpose. You cannot use it in your exams. Okay. So that's about this capital structure theory number one, which is net income. Now, if I ask you, look at these three stages in very detail and tell me what shortcoming or what mistake do you find in this net income approach? Do you find any shortcoming or any mistake in this net income approach? Any shortcoming or any mistake in the net income approach? Yeah. Actually, that mistake or that shortcoming is going to lead to the next theory, which is the net operating income. Now, let me tell you what's the shortcoming over here. Look at the cost of equity number. Do you think that equity shareholders are going to demand the same 15% right? Do you think that these equity shareholders are going to demand uh, the same 15%, irrespective of whatever amount of debt you take? Is it the case that you're going to, get this, or you're going to, your equity shareholders are going to expect same 15% return, irrespective of what amount of debt you are taking? Of course not, right? Because if you take more debt, the risk for the equity shareholders increases, right? The risk for the equity shareholders is going to increase. And therefore, assuming that this is going to remain constant at 15% is not correct. And that leads to the next theory or next point of our discussion, which is the next theory is net operating income. Net operating income approach, or NOI approach. What are the points stated by the net operating income approach? Right. So first thing is cost of debt is less than cost of equity. The first point remains the same. However, for the second point, they say as weightage of debt increases, the second point we say as the weightage of debt increases, there are going to be two effects of this. We know as the weightage of debt increases, overall cost of capital decreases, right? So as the weightage of debt increases, overall cost of capital decreases. But because of this increase in the weightage of debt, there is going to be one more offshoot activity from this, and that is expectations of equity shareholder also increases. Expectation of equity shareholders also increases. Now, what does this expectation of equity shareholder increases mean? It simply means, sir, the cost of equity shareholder also increases. Expectation of equity shareholder increases, and that actually makes the cost of equity also to be increasing. And as KE increases, what happens is KO will also increase, right? So cost of equity will increase. Now, since K is one of the component, it is also going to increase, right? KO is also going to increase. And as a result of it, as a result of this, KO remains constant. So now, as the cost of debt was less than cost of equity, there was a downward pressure on overall cost of capital. If you're taking more debt, the overall cost of capital was supposed to be going down, like we see over here. There was a downward pressure. But now what happens is, now we say, as in this scenario, we just draw a diagram for your easier understanding. See, this is cost of debt, and this was cost of equity. And what was happening is, the overall cost of capital was reducing. However, now if I say that cost of equity is increasing, sir, so instead of this, if I say that now the cost of equity is going up, this is not our cost of equity, rather cost of equity has gone up. Now my overall cost of capital won't be going down, right? Because this overall cost of capital will be actually becoming constant figure. So the overall cost of capital, which was actually moving down earlier, now due to KE, it will be becoming a constant figure because there is a double-sided pressure on it, an upward pressure due to KE, a downward pressure due to cost of debt. So ultimately, what we will see in the market is that, sir, there is a dual pressure on the overall cost of capital. It is being dragged down due to increased weightage of debt. It is also pulled up due to increased K, and that will make our overall cost of capital to be constant. Now let's look at certain numbers for that understanding. Let's say this one. Look at this. See, as the weightage of debt is increasing, we find that the overall cost of equity is also increasing. If I just, sorry, we find that the cost of equity is increasing. So if we let's look at how do we calculate the KO by simply multiplying weightage of debt with cost of debt plus weightage of equity with cost of equity. That will make the KO the calculation. We can say at every case you will find that overall cost of capital is 15%. And that's how this typical chart would look like. Yeah, somewhat like this. So as you increase the weightage of debt, as you increase the weightage of debt, what we observe is uh, K starts increasing, the overall the cost of equity starts increasing. That puts the dual pressure on overall cost of capital, and that makes the overall cost of capital a constant figure, right? So that's from the second point. We take as the weightage of debt increases, as the weightage of debt is increasing, KO is going to decrease, and of course, there is going to be other activity that's happening, and that is expectation of equity shareholders is going to increase. As the expectation of equity shareholder increases, KE also increases. As we observe over here, earlier the KE was 15%, now it became 19%, and then it becomes 55% if you take more debt. And the cost of overall cost of capital also increases. The dual pressure is going to cause the KO remaining constant. Okay, fine. So over here, again, you can say there is an assumption that as KO increases, the same amount of decrease is also there. Or I can say that decrease in KO and increase in KO is offsetting each other. That's the assumption that which this net operating income takes into account. Okay. Now, of course, as a third point, what we can assume or what we can state is that as KO is constant, as KO is constant, value of the firm also remains constant. Value of the firm also remains constant. Okay, since the formula remains the same, so that's going to be value of the firm remains constant. So over here, can I say change in the capital structure? Change in the capital structure has no impact. Change in the capital structure has no impact on the firm value. Change in the capital structure has no impact on the firm value. Okay. That's the second theory that we approached. that's net operating income approach, which is again, it was a theory of irrelevance. Net income approach was a theory of relevance. So we have done two theories, one pertaining to theories of relevance and the other was pertaining to theory of irrelevance. Now we have to look for the third theory before we go for the further discussion, or rather, I would like to bring in over here the net operating income approach with the tax, or approach with the tax. See, net operating income with the taxes, or that's called as model. That's also the model. Now, what does model say? Model says, first thing is that cash flow for company with debt, cash flow for company with debt is going to be greater than cash flow for company without debt. Cash flow for company with debt is going to be greater than cash flow for company without debt. That is what they mean. Okay, so how do we talk about this cash flow for company with debt and cash flow for company without debt? Let's try to understand it with the help of some numbers. Okay, so we have a levered firm. Levered firm means which has got the debt, and we have unlevered firm which is having no debt. Now, if you look at the cash flows, we begin with the EBIT, right? Earnings before interest and taxes. So earnings before interest and tax is, let's say, 10,000 for both the firms, less interest. Let's say the levered firm is paying interest of 3,000, or maybe interest of, let's say, 4,000. Of course, unlevered firm won't be paying any interest. So we have profit before tax as 6,000 and 10,000. And from that, we deduct the tax, let's say at the rate of 30%. So that's 1,800 over here, and that's 3,000 over here. We get a profit after tax of 4,200, and here it is 7,000. No, sir, the PAT for levered is less than the PAT for unlevered. Then how are you saying that cash flow? I'm talking of cash flows, guys. So let's talk about the bank account. Let's talk about a bank account of levered and unlevered. Now, in the bank account, both of them have got a debit of 10,000 because that's the EBIT, right? EBIT is the income which both of them have made it. Now, I'm talking of only those cash flows which are going outside the business. And from this EBIT, they're actually paying taxes of 1,800. And over here, you're paying tax of 3,000. Along with that, you're paying interest over here, 4,000. And dividend as 4,200. Here you are paying dividend as 7,000. So if I ask you, what is the payout to fund providers? What is the payout to fund providers? In case of levered firm, there are two fund providers. One is the debenture and other is the equity shareholder. So debenture holders are getting 4,000 plus equity shareholders are getting 4,200. So 8,200 is being earnings of the fund providers. And the payout to fund providers, over here, it's going to be 7,000. So what we observe is 8,200 is the payout to the fund providers and 7,000 is the payout to the fund providers. So which company is actually giving out more cash to its fund providers? Which company is giving out more cash to its fund providers? Of course, the levered firm, right? So that's what we mean over here. The cash flow for company with debt is going to be greater than cash flow for the company without debt. Now, how is that possible that the fund providers are getting a greater cash flow as compared to the firm which has got debt, that is paying out more as compared to the firm which is not having debt? So if you look at the difference over here, additional payout, additional cash flows will be 8,200 minus 7,000, which is 1,200. Right? Additional cash flows are basically 1,200. Now this 1,200 is actually tax savings on 1,200 is actually tax savings on debt, or it's basically tax savings on interest, right? So tax savings on interest means what was the interest over here? You observe interest is 4,000. So that 4,000 multiplied by 30%, which was 1,200, that is what is extra cash flow is. So as per MM model, they say additional cash flow in levered form is interest amount multiplied by tax rate. If I ask you, what is the value of additional cash flow? What is the value of additional cash flow in levered firm? What is the value of additional cash flow in levered form? That's going to be interest into tax rate divided by cost of debt, right? Because if it again becomes a geometric progression. So that's going to be interest into tax rate divided by cost of debt. So it is interest upon KD into tax rate. Now, interest upon KD into tax rate. So what's interest upon KD, by the way? Interest upon KD was the value of debt multiplied by tax rate. And that's where they say that since there is that additional cash flow coming in, third point they say is the value of levered firm is ideally equal to value of unlevered firm. Value of levered firm is ideally equal to value of unlevered firm, and that's going to be a scenario when there are no taxes. If we bring in taxes into consideration, then this same thing becomes value of levered firm is equal to unlevered firm. But since the levered firm is having additional cash flow, we add this additional value to the value of levered firm, which is going to be value of debt multiplied by tax rate. The value of levered firm will be value of unlevered firm plus value of debt into the tax rate. So that's your levered firm value. Okay. So remember, whenever there are taxes in picture, when we have taxes, we have to use this model, which is net operating income with taxes. And for that, we need to be looking at this formula. Value of levered firm is equal to value of unlevered plus value of debt into tax rate. Okay, so that's your net operating income approach with taxes. Right? Now, the next theory which we have to look at essentially is the traditional theory. So let's have a look at this traditional theory. Well, the traditional theory is a combination of net operating income and net income approach. It's a combination of both. So it actually divides the weightage of debt. It divides the weightage of debt, the level of debt, into three stages. Divides the weightage of debt into three stages. So the first stage is somewhat similar to the net income. Second stage is similar to net operating. And the third stage is altogether a different story. Now, amount of debt that you take, it's divided into three stages. Now, when I say three stages, in the very first phase, we say we are going to take some small amount of debt. Now, very marginal amount of debt, a nominal amount of debt, will not spur your equity shareholders to raise their expectations, because equity shareholders will be like, small borrowings is going to be a regular activity in business. So they won't be raising their expectations. So we can say debt will not affect KD or KE. And therefore, since your KE is constant, KD is constant, and KD is lower than KE, there will be a downward pressure and KO will start falling. And of course, as the KO falls, value of the firm is going to increase. And this is similar to our net income approach. If you take some more amount of debt, right, let's say maybe 5% debt was okay over here. Now, if you're taking another maybe up to 20%, right? So of the total capital, if you take around 20%, up to 20% of debt, now the equity shareholders will start raising their expectations, because that's a threshold which they have set. So KE will start increasing. As the cost of equity starts increasing, KD is constant, K is moving up. So now on KE, there is a dual pressure that applies. There is an upward pull by increase in KE. There's a downward push due to the KD, or increase in the weightage of debt, and that makes the overall cost of capital remaining constant. That's similar to our net operating income. So since KO is constant, even the value is going to remain constant. In the third phase, cost of debt and cost of equity both are going to increase. Cost of debt is increasing, or cost of equity was anyways increasing. But if you take greater amount of debt, the bankers are not going to provide you debt at the same rate. The bankers will start asking for a higher rate of interest. As they ask for a higher rate of interest, even the overall cost of capital is going to increase. Right? The overall cost of capital is also going to increase, and that's where the value of the business will start reducing. Okay, so that's what we mean by the traditional theory. And over here, you will find that the optimal capital structure lies in the second phase, wherein the KO is a constant figure. KO is a constant figure over here. Since KD was a constant, K starts rising, and KO was constant because at its lowest level. And that's where it makes the most optimal structure, which is similar to the net operating income approach. And ideally, the company should be having the weightage of debt within this two limits of phase one and phase two. Okay, so we have learned four approaches. One is the net income approach, then it was followed by net operating income. Third is the net income followed by net operating, then the net operating income with the taxes, and then we have this traditional approach. Jyoti Jai is asking phase one not clear. In phase one, small amount of debt the company is taking. Company is going for some marginal amount of debt, maybe 1 or 5 lakhs. Now, if it's 100 crore company and if it goes for borrowing, maybe just few lakhs, that's not going to impact the overall cost of capital anyways. Not going to impact the cost of equity anyways, because the cost of equity or the equity shareholders are not going to have higher expectation because they know that it's a part of regular borrowing. So KE is going to remain constant even in the first phase. But as you proceed in the first phase, the KD is remaining constant, K is remaining constant. That actually brings down the KO. That actually brings down the KO. The value of the firm will increase similar to the net income approach. So as you move along this, because of smaller amount of borrowings, variable amount of borrowings, you will find that KO is reducing, and that will actually cause the value of firm to increase. Okay, so with that we have done quite a few theories. We are left with the theory, or arbitrage. Basically, this model is basically the arbitrage model. We have to discuss that. We'll take it up post the break. Okay. So let's take a break now. After break, we will do some practical questions and then go for the arbitrage theory. Okay, so let's take a break now, guys. So let's get started, guys. After the break, we are back. We are going to do some practical problems of this capital structure theory. So let's get started with question number one of the handout. I have already uploaded this handout. You can easily access it. I think the last class itself you might have downloaded it. Let's begin with few questions. Question number one, guys. Let's look at question number one. Lakshmi Limited is expecting an annual earnings before payment of interest and tax of rupees 2 lakhs. The company is in its capital structure as 8 lakhs in 10% debentures. The cost of equity or capitalization rate is 12.5%. You are required to calculate value of firm according to net income approach. Also compute the overall cost of capital. So based on this, we have some information. We have this question one. Its expected earnings before payment of interest and tax is 2 lakhs. So EBIT, earnings before interest and tax, is given as 2 lakh. The company in its capital structure has rupees 8 lakhs in 10% debentures. So it means they're having some amount of company in its capital structure has 8 lakhs in 10% debentures. Cost of equity is 12.5%. And we have to compute the value of the firm according to NI approach, and I will also compute the overall cost of capital. So we say debentures or value of debt that we have is 8 lakh. Value of debt is 8 lakh. Cost of debt is 10%, and cost of equity is 12.5%. Cost of equity is 12.5%. You are required to compute the value of the firm according to NIM. Now, since we have EBIT, value of debt, cost of debt, and cost of equity, value of debt is fine. What we need is an income statement. So with the help of this income statement, let's say EBIT is 2 lakh. From that, we are going to subtract the interest. And that interest is 8 lakh into 10%, which is 80,000. And we say profit before taxes 1,20,000 less tax. Of course, there is no point of tax because this is without any taxes thing. So PBT or PAT is 1,20,000. Now, based on this figure, if I ask you what should be the value of equity, as we know the formula, it is PAT upon K. So PAT is 1,20,000 upon cost of equity is 12.5%. 1,20,000 divided by 12.5%. 1,20,000 divided by 12.5%, which is 9,60,000. Value of equity is 9,60,000. So After this, the question says compute the overall cost of capital, also the value of the firm. Now, what about the value of the firm? So the value of the firm will be value of equity plus value of debt. Value of equity is 9,60,000 plus value of debt is 8 lakh. Value of equity is 9,60,000 and value of debt is 8 lakh. Overall value of the firm is coming out to be this is what 17,60,000, right? That's overall value of the firm. And if I ask you overall cost of capital KO, that is simply EBIT upon value of firm. So how do we get this, by the way? Since we know value of the firm is EBIT upon KO, therefore KO will be EBIT upon value of the firm, which works out to be EBIT is 2 lakh upon value of the firm is 17,60,000. KO is 2 lakh divided by 17,60,000. That's 11.36%. Overall cost of capital, 11.36%, right? So that's solution to the question number 1. Similarly, let's try to answer the next question, which is question number 2. Assume in the illustration given above, the firm decides to raise further 2 lakhs by issue of debentures and to issue proceeds thereof to redeem the equity shares. What we're saying is that the firm decides to raise further 2 lakhs. It means the firm is having 8 lakh as the value of debt as of now. Firm is having 8 lakh the value of debt. Plus added to that 2 lakhs. So that becomes 8 lakh plus 2 lakh as 10 lakh by issue of debentures and to issue proceeds thereto and to issue proceeds thereof to redeem the equity shares. You are required to calculate the value of the firm according to net income approach, and we have to also compute the overall cost of capital. Okay, so there's a case that we are raising additional 2 lakhs. So if we are going to raise additional 2 lakhs, now the value of debt will be value of debt will be 8 lakh original debt plus 2 lakh, because the question says you are going to raise further 2 lakhs. So when you're raising further 2 lakhs, the value of debt becomes 10 lakh. And cost of debt, is it increasing? Is the cost of debt increasing? No, it means we have to assume the cost of debt same 10%. Value of debt 10 lakh, cost of debt is also 10%. So now, what is our EBIT? So if you replace your equity with debt, your EBIT is anyways going to remain constant. Right? EBIT is going to remain same as 2 lakh. However, the amount of interest which you are going to subtract is going to be now 1 lakh, which is 10 lakh multiplied with 10%. And that's profit before tax. From that, of course, no taxation. So our PAT will continue to be 1 lakh. Now, when we talk of the value of equity is PAT upon K. So PAT is 1 lakh upon cost of equity will be obviously whatever we had, that was 12.5%. So value of equity will become 8 lakh, and added to it, value of debt is 10 lakh, which makes the value of the firm as 18 lakh. And what do you say about the overall cost of capital? The overall cost of capital is EBIT upon the value of the firm. That's EBIT upon value of the firm. EBIT is 2 lakh upon value of the firm is 18 lakhs. 2 lakh upon 18 lakhs. 2 divided by 18. That's 11.11% is the overall cost of capital, KO. KO is 11.11%. Okay, fine. So that's question number 2. Let's try out question number 3 now. Let's try out question number 3. Modern limiters is expecting an earning before interest and tax of 4 lakh, and it belongs to a risk class of 10%. You're required to find out the value of the firm and cost of equity capital if it employs 8% debt to the extent of 10%, 35%, or 50% of the total financial requirement of 20 lakhs. Now, it says that it belongs to a risk class of 10%. Remember, whenever you see the word risk class of 10%, it means we are talking of overall cost of capital of 10%. Talking of overall cost of capital to be 10%. So EBIT is 4 lakh. Earnings before interest and tax is 4 lakh. And it belongs to a risk class of 10%, KOA of 10%. You're required to find out the value of the firm and cost of equity capital with the debt being employed to multiple extents. Okay. So there are 3 cases basically which we want to evaluate over here. Let's look at the 3 cases. Okay. Weightage of debt and weightage of equity. Weightage of debt, we want to see 20%, 35%, 50%. So of course, the weightage of debt is 20. So weightage of equity will be 80%, say 65%, and 50%. And irrespective of whatever amount of debt, they have given that it's a risk class of 10%. Overall cost of capital is 10%, 10%, and 10%. Okay. Now, EBIT level, irrespective of what amount of debt you take, EBIT will be 4 lakh, 4 lakh, and 4 lakh. Irrespective of amount of debt you take, EBIT is going to be 4 lakh itself, right? Now, total fund requirement is given as 20 lakh. If I ask you, what will be the value of debt? Value of debt. What's the amount of value of debt going to be? Right. So when we talk of value of debt, it is going to be weightage of debt into funds required. Weightage of debt into funds required. Weightage of debt into funds required. Weightage of debt is 20% and fund requirement is 20 lakh. So 20 lakh into 20%. Of course, the weightage of debt is 4 lakh, or instead of funds required, I'll just write it as multiplied by 20 lakhs. So we have 4 lakh as the weightage, or I can say the value of debt. In the second case, that's 35%. So fund requirement of the total fund requirement, total financial requirement is 20 lakhs. So for that, it is going to be 35%. So 35% is going to be 7 lakh. And in case of 50%, that means it is 10 lakh, right? So now, if I ask you, give me the profit after tax figure over here, that should be ideally EBIT minus interest multiplied with, or I can say this is going to be the EBIT minus value of debt multiplied with interest, multiplied with interest rate. So that's ideally EBIT of 4 lakh minus value of debt of 4 lakh multiplied with, what's the tax rate? What's the interest rate? Interest rate is 8%. So 4 lakh into 8%, that will make it as 4 lakh into 8% is 32,000. So 4 lakh minus 32,000 is 3 lakh 8,000 is the profit after tax. Then second case is 4 lakh minus 7 lakh into 8%. 7 lakh into 8%, which is 56, minus 4 lakh, 3 lakh 44,000. And in the third case, it is 4 lakh minus 10 lakh into 8%, which is 3 lakh 20,000. That's your profit after tax. Now, based on this profit after tax, if we talk of what should be the cost of equity, what should be the cost of equity? The cost of equity is going to be, of course, PAT divided by the value of equity. So we don't know what is the value of equity. Okay, so we cannot compute cost of equity, but can we get the value of firm? Yes, we can. Value of firm will be EBIT divided by KO. So in the first case, EBIT is 3,68,000 divided by 10%. 3,68,000 divided by 10%. That's 36,80,000, which is the value of the firm, right? Then we have PAT as 3,44,000 divided by 10%. That's the overall cost of capital. One second, I'm making some wrong number. Yeah, EBIT is 4 lakh. EBIT is 4 lakh divided by 10%. It is always going to be a 40 lakh figure. 4 lakh divided by 10%. 40 lakh. Even in the third scenario, 4 lakh divided by 10%. 40 lakh. That's the value of firm. Now, if I ask you what is the value of equity, you will say the value of equity will be value of the firm minus value of debt. It is simply 40 lakh minus value of debt as 4 lakh. So that's actually 36 lakh. Second case is 40 lakh minus 7 lakh, which is 33 lakh. And in the third scenario, 40 lakh minus 10 lakh, which is 30 lakh. Value of equity is 36 lakh, 33 lakh, and 30 lakh. That's your value of equity. And then we want the cost of equity, which is going to be PAT divided by value of equity. PAT divided by value of equity. 3,68,000 divided by 36 lakh. That's 10.22%. Then it is 3,44,000 divided by 33 lakh. That's 10.42%. And the last figure is 3,20,000 divided by 30 lakh. That's 10.67%. Right? These are our cost of equity figures. Getting it, guys? Nyanesh is asking, can I calculate value of equity as 20 lakh minus value of debt? No. No, Nyanesh, you cannot, because that percentages are given just to identify the amount of debt you need. Okay. Value of equity is where we are talking about what will be the equity figure in the market. What will be the value of equity shares in the market? Okay. Fine. Let's proceed. Got it? Great, guys. Let's do some more interesting questions. Let's do a very intuitive, very puzzle question, which is probably which is it? Question number. Let's try to do probably question number 6. Company wants perpetual debt, all equity finance, not this. Not this, but all equity 200 lakhs, replace 15% debentures. Let's try to solve question 6 now. Yeah, question 6. Let's try to solve question number 6. RES Limited is an equity finance company with a market value of 25 lakh. It has got a market value of 25 lakh and the cost of equity is 21%. The company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt. So we want to raise debt 5 lakh. So we want to replace our equity shares. We will buy back the equity shares, and instead of that, we will be raising money through debt. The rate of tax may be taken as 30%. After capital restructuring and applying model with taxes, you are required to calculate market value of RES, cost of equity KE, weighted average cost of capital, and you have to comment on it. Okay. So what all information we have with regards to these two companies, or not basically companies, these are two different companies, but it's the same entity. But earlier it was unlevered, and now it's looking for a levered form. We have RES, which is a 100% equity firm, and second we have the same RES, but now it is a levered firm. Okay. Let's first jot down the information that we have, and then we will write down the answers, or try to solve it. So based on the information that we have, it has got a market value of 25 lakh. Okay. So value of the firm, which is 100% equity, that's 25 lakh. Okay. Cost of equity is 21%. Company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt of the same amount. The company wants to buy back equity shares worth 5 lakh. So value of debt, we are going to have it in the levered form as 5 lakh. Cost of debt is 15%. Cost of debt is 15%, but remember this 15% is before tax cost of debt. Tax rate is 30%, irrespective of whether you are a levered or unlevered form. So we have all the information, and what we want is the market value of RES, that's the overall value of the firm after the leverage, cost of equity, and then the overall cost of capital. Fine. So let's first write down with EBIT. EBIT. From that, we are going to reduce the interest. So we get profit before tax. From that, we are going to reduce the taxes, which will give us profit after that. Now, as per the information, what we have, how can we fill up this? First, we are talking of this point, that is the 100% equity. Let's first fill up that, and then we will gradually move to the levered entity. For RES, we have the cost of equity as 21%, and the value of firm is 25. You can say value of firm is 25 lakh. Can I say that itself is the value of equity? So PAT will be computed over here. PAT will be computed over here as 25 lakh multiplied with 21%. 25 lakh into 21% is 5.25 lakhs, or that's 5 lakh 25,000. Then we have to simply do the reverse calculation over here. It's a reverse calculation. Then only we are going to get this entire sum done. So 5 lakh 25,000, that is after tax figure. So we know profit before tax, if that 100, tax is 30%, and PAT is 70%. Profit before tax is going to be computed. So we can do just a cross multiplication like this. So 5,25,000 into 100 divided by 70 by simple cross multiplication. We can get this as 7,50,000 and the tax figure is 2,25,000. EBIT and interest. EBIT is of course 7,50,000 because there's no interest in the first scenario. Now, when we are moving to the levered entity, of course, the EBIT is going to remain constant as 7,50,000. Interest will be 5 lakh debt multiplied by 15%. So 5 lakh multiplied by 15% is going to be the interest. 5 lakh multiplied by 15%, that's 75,000. So that gives us a profit before tax as 6,75,000. Now on this, you're going to pay 30% tax. So 6,75,000 multiplied by 30%. That's 2,02,500. And our PAT is going to be 4,72,500. 4,72,500. Okay, so we have this income statement ready. Now we have to do some other calculations. How do we go about valuing the RES Limited and the cost of equity and cost of capital? All those things are yet to be discussed. So let's talk about value of the firm. So the value of the firm over here, it was 25 lakh. And for levered firm, it is going to be, we are going to use that formula. You remember, guys? Value of levered was value of unlevered plus the amount of debt multiplied by tax rate. The amount of debt multiplied by tax rate. So value of levered will be value of unlevered plus debt into tax. So applying that, we can say value of levered is unlevered plus debt into tax, which is 25 lakh plus debt amount is 5 lakh multiplied by the tax rate of 30%. So that is 26 lakh 50,000. Value of firm is 26 lakh 50,000. And since we know that there is some debt component over here, there is a debt component of 5 lakh. We have value of equity as 21 lakh 50,000. Value of equity is 21 lakh 50,000. The value of firm is 26 lakh 50. Value of debt is 5 lakh. Value of equity comes out to be 21 lakh 50,000. From this, we can get a lot of other calculations. First up, cost of equity can be computed. Cost of equity will be done as PAT upon the value of equity. PAT is 4,72,500 divided by 21,50,000. 472,500 divided by 21,50,000, which is 21.98%. Yeah, 21.98%. So what was the question asking for? It was asking for the market value of RES Limited, which is this figure. Cost of equity, which we got it as 21.98. Weighted average cost of capital. Now, how do we get the weighted average cost of capital over here? See, calculation of KO in levered situation. Calculation of KO in levered situation. We have got the equity and we have got the debt values also. Amount and then the weights. Amount is 26 lakh 50. Cost, and then we take the product. Overall value of the firm was 26 lakh 50, out of which value of debt was 5 lakh and value of equity is 21 lakh 50,000. So equity is 21 lakh 50,000. Debt is 5 lakh. So total is 26 lakh 50. Cost, as we have computed, overall cost of capital is what you have to compute. So cost of equity is 21.98%, and debt, cost of debt, it was, can we take cost of debt as 15%? No, we have to take the cost of debt as after tax. So after tax KD, after tax cost of debt will be 15% multiplied with 1 minus 0.3. That's the after tax figure. 15 into 0.7, you can say, which is 10.5%. The after tax cost of debt is 10.5%. Weightage wise, you can simply say 21 lakh 50 divided by 26 lakh 50. The weightage will be 0.8113, and over here it will be 0.1887. If you take a product and take a total, this should be, product will be 17.83, and in the second scenario that's 1.98%. If you take a total, that's 19.81%. Overall cost of capital is 19.81%. By the way, to calculate overall cost of capital, we have another shortcut. Instead of doing this entire series, you can simply have a shortcut also, wherein you can say KO is EBIT into 1 minus T, EBIT into 1 minus tax rate upon value of the firm. EBIT 1 minus T upon value of the firm. So EBIT is 7,50,000 into 1 minus 0.3 upon value of firm is 26,50,000. You can get the overall cost of capital by this shortcut also. Just check 7,50,000 into 0.7 divided by 26,50,000. We're getting the same 19.81%. So whenever there is a tax scenario, you can get the KO after tax figure in this fashion. Right? So you can have a shortcut for KO with taxes scenario. Shortcut for KO with taxes scenario. Okay, so that's how we get the overall cost of capital. Are we clear with this, guys? Are we clear with this? Yep, true. Are we good with it? Are we good with it, everyone? Okay, fine. Now I would like to go for the last thing, which is the arbitrage model. Modi Gilani Miller arbitrage model. In exam, shortcut can be used. Yes, you can use it, Jyoti. With taxes we have seen. We have to now discuss what will be the case of arbitrage. Now, before we go for arbitrage, I want you to tell me, are you aware of this term called as arbitrage? Are you aware of this term called as arbitrage? Yeah, aware of this term arbitrage. Well, arbitrage is simply taking advantage of the price differential, in two markets. For example, if I tell you there are two stock exchanges, one is BSE and other is NSE. Now in BSE, one share of Reliance is being sold for, let's say, 3,500. In NSE, same share of Reliance is being sold at, or that's being traded at 3,510. What will be your course of action? As soon as you see these prices, in one exchange it's 3,500, in another exchange it is 3,510. What will be your course of action? Are you able to see that there is a possibility of profit? Yes, of course, sir. What will you do to exercise, or what will you do to exploit this profit opportunity? Of course, you will buy in NSE and you will buy in BSE and you will sell in NSE. You're going to buy in the Bombay Stock Exchange and you're going to sell it in the National Stock Exchange. You'll purchase from BSE and sell it at NSE, right? So that's the typical arbitrage which we are talking of. That's what we mean by arbitrage. Buy from BSE and sell at NSE so that you have a profit of 10 rupees. So tell me, where are you going to sell? You're going to sell the overpriced, right? And where are you going to buy? You're going to buy wherever it is underpriced. Wherever it is underpriced, you're going to buy it. Wherever it is overpriced, you're going to sell it, right? So that is what this arbitrage transactions. Now, similar arbitrage is also going to happen between two firms. So for that, let's look at this question number 10. We're going to understand the arbitrage process through question number 10. There are two companies, N Limited and M Limited. Okay, so there are two companies, N and M, having same earnings before interest and taxes. That is EBIT of 20,000. In question, every sums are difficult. NSE and BSE are stock exchange. NSDL are CDSL are your depository, where your shares are held. Okay. Coming back to question 10. So there are two companies, N and M, having same EBIT of 20,000. M is a levered company, which is having a debt of 1 lakh. and it's a levered company having a debt of 1 lakh at 7% rate of interest. Cost of equity of N Limited is 10%, and for M Limited is 11.5%. How the arbitrage will be carried out. So let's try to understand this. How it is going to happen. So first up, for for N Limited and for M Limited, no, N Limited was a unlevered, M Limited was a levered entity. So both of them were having a EBIT of 20,000. Since it was unlevered, no interest for it. Since M Limited was a levered entity and it was having a loan of 1 lakh, on 1 lakh, there's a loan of 7%. So interest of 7,000 and we get a PAT or PBT of 13,000. Cost of equity for N Limited was 10% and cost of equity for M Limited was 11.5%. Cost of debt is 0 and cost of debt over here is 7%. A value of equity, we know it can be computed as PAT upon K. So 20,000 upon 10%, 13,000 upon 11.5%. That will give us the value of equity. Value of debt is given as 1 lakh and value of the firm is 2 lakh and 2,13,043. Now, if we look at both the entities, which company is having a greater value? Which company is having a greater value? The levered entity is having a greater value. And what did we see? That we are going to sell the share in which market? We're going to sell the share in which market? Can I say whichever is overvalued, we are going to sell it and we are going to buy the undervalue. So over here, which company are we going to sell? Tell me, guys. Are we going to sell the levered or the unlevered? We have set out the rule. We are going to sell the company which is overvalued and we are going to buy the company which is undervalued. So which one are we going to sell? Of course, M Limited, right? We are going to sell the M Limited or the levered entity. So we'll be selling the levered entity. So let's say as an investor, I have 10% shares of M Limited. I'm having 10% shares of M Limited. So what will be the value of the investment that I have? Of course, 10% of stake in M Limited. So 10% shares I have of M Limited. So that will be 10% of this. And I'm looking at selling my shares over here and putting them in this case. Selling my shares of a levered entity and buying the shares of unlevered entity. Okay. So let's see what's going to happen. We are going to sell the proceeds of 10% from M Limited. Yeah. So when we sell 10% stake in M Limited, we are going to get, can I say, out of 1,13,043 total value of the business, of that we are going to get 10%, which is 11,304. But remember, when we are an investor in M Limited, we had an indirect loan. We had an indirect loan of 1 lakh, right? the company had a loan of 1 lakh, out of which 10% was attributable to me because I was 10% shareholder. So I was undertaking 10% risk of the entity. So if the company defaults, my shares will be reduced to that much extent. My share value will reduce to that much extent because I have to bear that risk. So 11,304 is what I'm going to have, but I cannot put this entire money over here in the first company and then say that I'm going to compare the earnings. No, that's not possible. So if I want to have that comparability, we are going to match the risk. Earlier, there was an indirect loan on me of 10,000 because 1 lakh was the total. Of that, 10% was attributable to me. So I have to take that risk. I have to match that risk. So we will take a loan of 10,000 at 7%. It's the same rate at which the company was taking loan. So it's the same rate at which the company was taking loan. So to match the risk profile of both investment, we'll take a loan of 10,000 at 7%. So total funds that will be available to us will be, can I say 11,304 plus 10,000 loan. Remember, I am repeating it again and again. When I was an investor in M Limited, my investment was 11,304, but I had a loan indirectly on me of 10,000. So I have to match it, and therefore I'll take a loan of 10,000 over here, which is 21,304. That's the total amount which we will invest this 21,304 in the first company, which is a levered entity. So by investing 21,304, I will acquire 10.652% stake in that company because that company was having an overall valuation of 2 lakh. Of that 2 lakh, 21,304 is what my investment is. So I get 10.652%. Now I want to know what is my earning in the new company. So my earning is going to be a percentage of the PAT. So PAT is 20,000. So 20,000 multiplied by whatever percentage stake you have in that company. So 20,000 into 10.652%, right? 20,000 into 10.652%, which gives me 2130.4 as the earnings. But remember, this earnings I cannot take home because I have to pay some amount of interest. I have borrowed, right? I said that to match the risk, I'm going to borrow 10,000, right? So 10,000 into 7%, which is 700. So I have a net profit for me as 1430.4, right? What was the income earlier? Sir, earlier I was having 10% stake. So I was having 10% of 13,000. It's 1300. So are we having anything extra income by investing in the other company? Yes, sir. From 1430.4, we were earlier earning 1300. Now we are earning 1430.4. So of course, we have 130.4 as the arbitrage gain. So the arbitrage gain for us is 130.4. Okay. So arbitrage gain that we have is 130.4. So that's where we can say an investor will actually move from a levered company to unlevered company. The investor will switch from levered company to unlevered company. And that's what we call it as a primary arbitrage. Now tell me, if the investors are going to sell the shares of M and they are going to buy the shares of N, that is, if they are going to sell shares of levered and they're going to buy shares of unlevered, what will happen over a period of time? Can I say the shares of M Limited will face a downward pressure because of selling, and shares of N Limited will enjoy a upward pressure due to buying. So as the investors are going to buy more and more, they will have 2 lakh as the N Limited earnings. They will have 2 lakh as the 2 lakh value will move up because investors are going to buy more and more of N, and investors are going to sell M. So as M goes down, value of N goes up. So the difference that we see in the value at the very first stage, that will get reduced, and eventually that will move on. Eventually that will just, eventually will, the value of both the companies will become same. as it would have happened over here also, right? Even in case of BSE and NSE example, if people are buying from over here and selling at NSE, if investors are buying in BSE and selling at NSE, of course, there will be greater demand in BSE and lower demand in NSE. Over a period of time, maybe this difference will not remain, or this difference will not pertain. It will slowly and steadily, gradually will move out, and the prices at both the areas, both the stock exchanges will remain same. Now, someone is asking, sir, how come the prices will be different in two exchange markets? Of course, two exchange markets, we may have different prices because the demand and supply is different in both the markets. So as the demand and supply is different, for that reason, even the values are going to be different. Even the values, the trading price is going to be different. You can simply say that price of a vegetable, it may be different in one market as compared to a market just adjacent to it, right? Sharon, how 10% in M Limited? Sharon, 10% is an assumed figure. We are considering a 10% stake in M. You can consider 50% also if you wish, but 10% is an assumed figure. So this is a arbitrage, which is a primary arbitrage. Similarly, if the investor moves from N Limited to M Limited, that will be a secondary arbitrage. We'll discuss about this arbitrage as well as a secondary arbitrage in detail in the revision class that we have a day later. Okay. I will upload this entire PDF file once we are done with the Thursday session. Okay. Once we are done with the Thursday session, I'll upload this because it has got the questions and answers for all the answers. I mean, all the solutions, so that you can solve it. You can try out the handout question. We'll also discuss few questions in the revision class. Right? All clear? Can you please explain the 10,000 loan taken? Sufal Pramod. 10,000 loan was taken to match the risk. Remember when we were invested in M Limited, I had investment worth 11,300 crore. However, the company was having a loan of 1 lakh. So actually, I was bearing that indirect loan. Okay. I was having that indirect loan of 10,000 because since I assume that I am owning 10% of the company, even 10% liability will be also on me because my share value will get reduced that much if the company defaults, right? So to match that risk, we actually went with the loan of 10,000, right? So that earlier the 10,000 loan which was indirectly upon me, now it is directly upon me. Okay, so with that, let's just stop here for the day, guys. We'll meet up again on Thursday for revising the ratio and the capital structure stuff again. Hani Agarwal is asking which assumption. You can assume any percentage, 10, 20, 50, whichever is your favorite number. But of course, not 100%. Okay, it's better to take 10%. Okay. So with that, let's just stop here, sir. We'll see you in the next class. Bye-bye and take care.